Good morning and good afternoon, everyone who's joining us today in the earnings call. That's the call for the purposes of going through the financial results of Acwa Power for the fiscal year ended 31st December 2022. For those of you who may not know us, bear with me for very quick introductions. As Sam introduced, I'm Osmer. I'm the head of investor relations at Acwa Power. To my left is sitting Paddy, Mr. Paddy Padmanathan, and who is the president and the CEO of Acwa Power. And to Paddy's left is sitting Mr. Abdul Hamid Al Muhaidib, and he is the group CFO of Acwa Power. We have some prepared remarks as usual for you, which Paddy and Abdul Hamid are going to mostly cover, and then we will open the forum for questions and answers. In the meantime, the presentation we will be sharing with you is already on the website. You might have already seen it. And in addition to that one, we have a very detailed management discussion and analysis, which is also available on the website for detailed analysis of financial results. So with that, I am passing the word to Paddy. Paddy?
Thank you. Good day to all of you. And once again, thank you very much for taking the time to participate in this call. It's my privilege and pleasure to be sharing with you our performance for year 2022. World over, it has been a very tumultuous, very challenging environment, a very difficult year. At some levels, no different, and we are in the world interconnected, very much relying on all the supply chains, all the partners right across the world. But very, very, very privileged and blessed to be able to announce that we have been able to deliver a very robust financial result. I think, I'd like to claim all the credit, but in fact, the honest truth is, yes, there's a very large team of people who are responsible for delivering the services that we provide, who develop the services, who then take it through to deliver it, and present these financial results. But underneath it all, it's our very robust develop, invest, operate and optimize business model that we have always talked about. That has, as you will see, as I kind of present these results, has put us in this excellent position. Every metric, operating profit, adjusted net profit, reported net profit, everything is well above our sort of performance of the previous year. So we're very, very happy. Some are excellent performance, earnings per share doubling. But this is all, as I said, sort of underpinned or fed by a record volume of capacity that we have brought online during the course of 2022, which is starting to kick into supplying earnings, and a record amount of power purchase and water purchase agreements that we have signed in terms of volume and in terms of capacity, which also has contributed to the developed segment of our value creation. And you've got the numbers in front of you. What I'd like to point out is that in the 5.4 gigawatts of new PPAs that we have signed, 2.1 or 2.06 is from that PIF pipeline, the framework contract that we have to deliver 75% of the capacity that the Kingdom of Saudi Arabia will be procuring renewable energy between now and 2030, that many of you who follow us are familiar with. So 2.06 megawatts is sort of additional in that pipeline that we have signed. And in terms of the other thing I'll touch on it just now, that 5.4 gigawatts represents a 12% capacity addition to our portfolio. Interesting news, the entire amount of that 5.4 gigawatts is in renewable energy. So we've added 12% to our portfolio, all of it in renewable energy. And the 600,000 cubic meter a day water purchase agreement we signed is adding 10% to our desal capacity. So these are all very large plants. They may be one or two or three, but they tend to be of significant volume. We've achieved 3 financial closes. That's kind of over 8 billion Saudi riyal. And we've also happily brought 7 plants into different stages of production, adding 1.8 gigawatts and 1.1 million cubic meters of desal water a day, which is contributing to our revenues. For me, and I'm sure for the world, one of the most exciting things is that everybody is watching is this at-scale green hydrogen plant that we've been developing, which had already gone into construction during the course of 2022. Just in the last few days, or I think on the 1st of March, yesterday, we announced the financial close. We call it dry because, okay, it's all irrevocably signed off finance documents. We're just completing some CPs to draw down of 6.3 billion non-recourse project finance debt into this project. So this project is effectively fully funded now. And as I said, construction is earnestly underway. So we're truly excited about this. More than anything else, because, okay, first of all, we have sort of seized the first mover advantage on what the world recognizes as potentially a significant game changer for decarbonization. By 2050, possibly giving as much as 20% of the energy of the world green hydrogen. But also this allows us, in order to now rush forward and replicate this plant with the confidence and the knowledge that we have gained through this first project. But everybody is focused on the hydrogen piece. But I think we shouldn't forget, behind that, what is fueling that 600 tons per day of carbon-free hydrogen is 4.6 gigawatts of solar and wind energy. So it's the largest, by far, green hydrogen plant being fed by the largest single-site wind farm and the largest single-site photovoltaic plant. Exciting project, very much looking forward to getting this completed and into production, but also now starting to replicate this elsewhere. And all of this adds to the decarbonization focus that we have as a company. Well, as I've already pointed out, all the power generation capacity was renewable energy that we added in 2022. And then on top of that, we managed to convert a couple of carbon emitting assets. The most significant, in my view, is the Hasian IPP, which was being built as a coal-fired power plant, which we have now worked with the off-taker to convert to a gas-fired power plant, thereby ending up with savings of 30 million tons of carbon dioxide by 2030. And Shuaiba IWP, independent water and power project in Saudi Arabia, which has been utilizing 22 million barrels of heavy fuel oil if we were to carry on operating it beyond 2025, coming to an agreement with the government to shut it down and decommission it by 2025, saving 9.5 million tons of carbon dioxide per year, but from 2025 onwards, and replacing that with a desalination plant, a reverse osmosis desalination plant, all done very much in accordance with the PPA and with a close collaboration with the Kingdom of Saudi Arabia, Ministry of Energy. Again, very much reinforcing the Kingdom's commitment to decarbonizing the power generation fleet as fast as possible, shutting down oil out of power generation by 2030. As I said to you, I think the real value is showing through of the develop, invest, operate, and optimize pillars of our business model. So I already have covered the significance of actions in develop and invest and operate part. And on the optimized part also, we had a very satisfactory year. We were able to raise new debt very competitively. In fact, it was the pricing was, albeit at the top end, but at the 2-digit range. And it was very heavily oversubscribed, just showing the demand that we had and the confidence in the marketplaces in us. We were able to recycle capital by partly divesting some of our assets, and we were also able to refinance fairly significant refinancing of Rawek and Baka, and restructure and refinance Shuaiba 3. And in terms of managing liquidity, in order to, having raised money, in order to then optimally utilize that money, we prepaid a convertible loan that we had taken from Silk Road Fund, and we also repaid some of our EBLs and partially paid down Acwa 39 bond, even though that bond, quite frankly, at that time when we placed it, was a very competitive landmark transaction. Given the pricing at which we are able to raise debt now, and given the size of our portfolio, it made sense for us to start doing that. Moving on now to the sort of operational side of the business. Here, I've got to be the first to acknowledge that we could have and should have done better. Some levels we have, but the most challenging for me and for the people concerned, of course, was the unfortunate losses we had in life. Even though we are struggling to implement and really drive home a zero harm environment, we did have accidents and we had loss of life during the course of 2022. Tragic. It focuses our attention on placing high priority on this subject. In our views, that we should be placing higher priority on this subject than on any other subject as we go forward. And from right through 2022, we've already started to take some very specific actions to enhance workplace safety. We have worked during the year 80 million man hours. The company, look, this is, I don't even really want to even get into this, but I am going to just make the passing comment. We've got a rapidly growing fleet. We've got a rapidly growing construction portfolio. As I said, in 2022, we worked 80 million man hours, but we did lose lives. We did injure people. So that's not acceptable. So I think we need to continue to work hard at that. And also on the operating platform, we have had outages. If we look at on the water plants, our availability is very robust, 97%. Love to be even higher than that. We'll continue to strive towards it, but this is okay. This is something that we can live with. On the power side, it's not been so pretty. Availability as a number is stark 87%, which is for sure way below standards and way below where we would like to be. Our balanced portfolio and this sort of, 4-pillar model allows us to continue to deliver, well, the excellent result that we have delivered. But I think on a long-term basis, we need to focus very much our attention on the things that we are poor at, where even within this balanced portfolio, within all these sort of wonderful other things that we do, I think we want to strive to be doing everything as best as we can. And definitely enhancing power availability is something that we will focus at. But if you look at it a little bit more deeply, you will find that we actually have a few problem children in our fleet. We've got 38, 42, and I'm going to get into trouble by inventing numbers, operating assets, of which we've got 2 very difficult children, Noor 3 and Al Marjan. We're very aware of the issues. We've been working through the issues. Noor 3 actually is now back online. Early days of being back online after a very long outage. So we're still sort of having a bit of teething issues, but hopefully we are on the right track. Al Marjan, we know exactly what the issues are, so we're working through that. If we take those 2 out, then the availability sort of bumps up to around about 90% level. Still not good enough. So we will continue to. So we've got a very specific reliability of supply program that we are working through, plant by plant, looking at single points of failures, looking at increasing monitoring, increasing automation, trying to do more and more preventative maintenance, and adding a hell of a lot more digital capability to these plants in order to continue to improve their performance. So that's a confession, and we're working on it. But otherwise, we're doing fine. I want to touch on the green hydrogen project, as I say, because there's an enormous amount of global attention at it. We ourselves, it's a huge project for us. It's one of our largest sort of single investment, and I think it's worth sort of spending a couple of minutes on this. As I said, we've achieved dry financial close on the 1st of March, $5.9 billion of senior limited recourse project finance debt and 0.5 billion of mezzanine debt. Bearing in mind that this is the first project of this scale, albeit of fairly well tried and tested robust technology, having limited recourse project finance and bringing on 26 banks and 3 financial institutions as our partners in this, I think, it's a remarkable feat, and we're very, very, very satisfied with the outcome. The plant has been developed. We started developing the plant 3 years ago. So it's a kind of pretty fast development phase, to be quite honest, given that it was a kind of, not the conventional one where we respond to an RFP. Here, we created this project, we convinced partners. So 3 years is pretty rapid. 2 years into the development, we were confident enough to go into full construction. So in fact, the project is well into construction now. But because of the way in which, and the world during this sort of 3-year period completely turned upside down, COVID sort of hit. Soon after we started developing, COVID sort of crash landed on Earth. And then we had, coming out of COVID, then we had, I don't want to go through all the messes, the tragic war and all the rest of it. So we've had inflation impact, no question. And we have also had base rate increments. So project financing costs have gone up. And so all in all, the project costs have gone up. But what we have been able to maintain the development phase, and we've been able to structure a project that was viable enough for it to be funded on a limited recourse basis, having all these other additional partners, and for us to be satisfied to invest and go forward with. We are truly excited about the opportunity this project has provided us. Within the project, we can get into any details if anybody is interested in it. There are opportunities for us to continue to improve performance as we bring the project online. The plant capacity is actually higher for a variety of reasons than the contracted values. So there is, as one example, so there's a lot of opportunity, and I think exactly like what we have done in all our other plants, as we get into operations, we are confident that we'll continue to be able to optimize operation and maintenance. And we have embarked on the third leg to our business, if you like, renewable energy, desalination, and now, or energy and desalination, and now green hydrogen. So as we develop more plants, we will again be able to take advantage of those new developments, even to filter back into this development. Quickly looking forward, before I hand over to Abdul Hamid on 2023. Priority, safety first. We really, really do need to focus on, and we are focusing on creating and maintaining a zero harm environment. And the second priority, as I said to you, I think we need to be honest and accept the things that we are weak at, continue to do the things we are good at, very good, but at the same time, put the focus on the things that we are not so good at. Reliability of supply. That generates a steady stream of cash income. That's a long-term, enduring, sort of year-by-year cash flow. So we're putting a lot of effort into reliability of supply. And then it's the routine business. We will complete all the projects that we are lining up to financially close. And then, of course, some of the projects that are in construction will come into either initial commercial operation or project commercial operation, the full commercial operation. So we need to kind of remain on track and not allow anything to slip by. And well, we're very busy adding new capacity in terms of bids. So just taking the PIF pipeline, and I think that's one of those things that everybody's tracking very carefully. I think in the IPO in the IPO prospectus, we had forecasted that by 2025, we should be contracting 11 gigawatts in that pipeline. Well, I'm happy to say we are ahead of schedule. We've got 1.5 Sudea project in construction, as you know. I just now told you that we signed PPAs for 2.1 gigawatts in 2022. Just in the first 2 months of this year, we have submitted over 4 gigawatts, a couple of projects of new offers within this pipeline, which obviously we'll be working very hard to convert to PPAs during the course of this year. So that's about 8 gigawatts already of our ambition to be at 11 gigawatts of contracted capacity by 2025. So we are in 2023. So I'm very confident that, well, first of all, we're clearly on track. We are clearly ahead of track. And all of this gives us confidence, and we will remain focused at decarbonizing our portfolio. And we will continue to lead the energy transition on a global basis, particularly as the Kingdom of Saudi Arabia and some of the markets that we work in offers us stunning opportunities. Thank you. Abdul Hamid. Sorry for taking longer than I should have.
Thank you very much, Paddy, and Assalamu alaikum. Good afternoon, everyone. And I would like to build it up from the great detailed intro that has been presented by our CEO and President, Mr. Paddy. What I will do, I will actually take you through the key KPIs from the hybrid view, and then we'll go through the details of each and the main drivers for these changes. So starting with the operating income before impairment and other expenses, we have seen a great growth this year to reach a level of 2.6 billion riyal. You have seen gradual, continuous, consistent growth over the last 3 years. Similarly, in the adjusted net profit attributed to the equity holders of the parent, we have reached 1.5 billion Saudi riyal, a new record also for 2022. This is around 32% increase from last year. Looking at the cash, parent operating cash flow, we have a remarkable year, mainly driven from refinancing specific assets. However, even with that number, there is a significant increase on the BOCF. We can take you through that details as well in the next few slides. That number for 2022 has been increased by around 160%. If you look at specifically the driver for them, we'll go through the details, but now I'll take you through the main business reasons behind these changes. So the first one was highlighted also by Paddy. We did actually brought great number of assets into operation, and these assets has been in different jurisdiction, different technologies, starting with Shura Energy 3, which is the phase 5 of Mohammed bin Rashid Solar Park. We were able during 2022 to bring online 300 megawatt in different timing. We have also brought fully Ad-Dur power and water in Bahrain. This is around 1,500 megawatt, together with almost a quarter of a million meter cube per day of desalination water. Al-Quwain, another big water project that we have brought partially online during the 2022. So this is around 450,000 meter cube per day that was brought online. Finally, there we have also brought the largest water desalination unit that we have ever built, and also the world have witnessed, which is Tawila IWP in Abu Dhabi. This is so far we have brought around 455,000 meter cube per day online, and the remaining 450,000 meter cube per day is coming throughout, inshallah, this year. So great number of assets came online during this 2022. Subsequent to that, and post 2022, we have announced also in January and February another 300 megawatt of Noor Energy 1 in Dubai coming online as well. This is from the operations side, and if you move into the project that have successfully achieved financial close during the year 2022, we had three. One of them is very interesting project where we have touched upon it. Also, Paddy talks about it a bit. Is Shaiba 3 IWP. So this is actually a legacy project that we had in Acwa Power, which is the first ever IWPP we built, which is Shaiba IWPP that is now going to be phased out or decommissioned, and in its place. We are building a great IWP, which is a water desalination unit, using part of the power coming from renewable. This is a 2.9 billion riyal investment. It will bring 600,000 meter cube per day once it's come online. We had also two other wind projects that we are building. Total capacity is 1,000 megawatt in Uzbekistan, Pasha and Desgandi. These are two projects we have successfully achieved the financial close during December of 2022. Overall, total three of them is around 8 billion riyal of financial closes. Also, subsequent to that, just highlighted by Paddy, we have successfully achieved NEOM Green Hydrogen, which is around $8.5 billion of project total investment. This is a huge asset that is now we are closing. We're working closely to bring it to the wet financial close, inshallah, in the next 2 months. Now, I would like to take you on a deep dive on specific KPIs. So let's start with the operating net operating income before impairment and other expenses. So this is where we have showed you that it went up 13% on 2022. Looking at the details, so the main drivers for that specific growth, around 438 million riyal is coming from bringing capacity online, which we just highlighted in the previous slide. Also, there has been, together with that, the O&M income for this specific asset that has been coming online. Second big factor also that the development and construction management fees has been increased in 2022 compared to the previous year, along with a specific reduction in the project development cost on the provisioning and write-off that we have compared to 2021. We have also recorded around 157 million riyal, mainly on recoveries, I would say. Recovery either with the insurance or recovering with the liquidated damages that has been related to accidents that is being during the year or during the previous years. This was offset big time 600 million riyal, mainly from unexpected outages, which was also highlighted by Paddy, and we mentioned about the reliability of supply targets. So this is mainly from the outages of Morocco and KSA, together with, I would say, having Barka PPA being expired. We are discussing also with the offtaker for potential opportunities as well for the future. Together with that, there is also a factor of high maintenance costs during some outages, which took longer than what was expected. So this brought us to around 2.6 billion riyal of operating income. Moving to the adjusted net income. Here we have recorded, if you look at it, we're going to build it up from where we have actually reached our profit. So the profit of the year doubled compared to 2021. And this is what has been highlighted earlier, that we are doing the adjustment from the beginning of our IPO prospectus. And as we are maturing, we are expecting less and less, let's say, different between the adjusted net income and the net income. So clearly this year we have only adjusted for a very small amount, which is around 55 million riyal compared to the previous year. We are delivering on that, and we expect, as we also evolve, less and less adjustments to the net profit that will happen. So looking at the adjustment of this year, it is a very small adjustment. One is around 54 million, which is mainly related to impairment on Barka assets. And also there is another 14 million riyal that is basically a reversal of an investment we had in Vietnam, where we have built up actually a higher development cost than was actually paid. So that brought us to around 1.5 billion Saudi riyal in terms of adjusted net profit, around 32% increase from last year. Moving to the consolidated net profit. So this is where we have shown you the double compared to 2021 2021 numbers. So if you would like to understand the big difference, which is mainly we have adjusted for last year, you can see that the main one was the 280 million Saudi riyal, which was the one-time share-based IPO grant that has been in 2021. This was a big impact that has been also adjusted for last year. There has been also a higher operating income to report, around 311 million Saudi riyal. Around 280 million, it's a net gain on a sale or divestment we have in Sidaria. So this is something that we have used to own 100%, where we have divested around 49, and we are now having a 51% in Sidaria. Finally, around 353 million difference is mainly because of the high income earned on the, I would say, financial optimization. I would say also related to liquidity management. So we have done great exercise of Acwa 39 bond divestment, 50% divestment. We have recognized around 75 million Saudi riyal gain on the principal, separate from the interest. And also we have managed to do some, I would say, liquidity management, where we have retired a couple of EBLs. We have also created a higher income from deposit that we had. That was countered by a few other elements, mainly 175 million related to higher finance charges as we brought Rabo 3 online. Now it is, and we have consolidated Rabo 3, so we have this cost coming to our PNL, as well as around 150 million Saudi riyal for higher, I would say, zakat mainly. Sorry, tax mainly. Zakat was around only 10 million riyal increase. However, the zakat is because of the deferred tax that we had in Morocco. And then we have also other costs of around 170 million. So that brought us to around 1.5 billion Saudi riyal. Moving to the building blocks of the adjusted net profit, and I don't want to repeat also the details of what we have mentioned earlier, but I think just linking what the story also have introduced by Paddy earlier, and also our four I would say values, which is develop pockets of investment, develop, operate, invest, and optimize. Here again, we are showing the diversity of our cash flow, where we are being able to successfully get income from every single pocket that we have from the four main drivers. So around 500 million coming from the development and construction management fee. We have showed the details earlier. Income from owning our shares on these specific assets, around 667 million riyal. Nomac has contributed 500 million riyal, and finally on the optimization and divestments and refinancing, we were able to bring in around 680 million riyal. So overall, the breakdown and the different pockets has contributed positively to the adjusted net income of Acwa. Looking into details of the current operating cash flow, if you look at comparison, you will see around 10% increase on the distribution from the assets. And then if you also add the management fees, it's around, I would say, equal to what has been done in 2021. However, the big component of change that had happened this year is mainly from the capital recycling. This is around 2.4 billion Saudi riyal. Of that total cash flow increase, we have done a couple of refinancing, which was significant contributor to this capital recycling. Rawak was the big one that we had done earlier this year in 2022. Also, we have done some capital reduction, including also some divestment of Shukek and other assets. So that is the main driver for the big change. Then taking you to a total parent cash operating cash flow of around 4.1 billion Saudi riyal. If you take out the total cash used, we will end up actually the year with around 4.2 billion riyal. It's almost equivalent to the cash position that we had earlier last year. Also, we have introduced this new slide based on also some investors' feedback. So this is presenting on a simple way where did we use the cash during the 2022. So around 1.9 billion riyal has been gone through investments. So these are investments either in Saudi, UAE, South Africa, Morocco, and including some repositioning ourselves in some project, which is mainly retiring of equity bridge loans. Then we had also around 2.4 billion Saudi riyal that has been in debt servicing, and this is while our debt servicing for the year was much less than that, but this is through the I would say liquidity management program that we have launched, which is around 2.4 billion. We have been able to pay back 50% of Acwa 39, and we have prepaid also a Silk Road Fund convertible loan fully during the 2022, creating a great saving in the principal and in the interest of overall paid during 2022. We have also distributed the cash dividends last year, which is around 562, together with almost 200 million positive impact from collection of LNTP payments that has been paid earlier. So net we end up the use of cash is around 4.7 billion Saudi riyal. Final slide I have before we open it up for the Q&A is the leverage. So if you look at our total liability on our balance sheet is around 24 billion Saudi riyal. If you exclude the non-recourse part of it, which is around 17 billion Saudi riyal, you will end up with around 6.6 billion riyal, which is on our balance sheet with recourse to Acwa Power. And this is mainly we have the revolving facilities, we have the sukuk, and we have the PIF loan. These are the main, I would say, recourse on our balance sheet. Then we will add also all the off-balance sheet recourse debt to it, which is around 6.5 billion Saudi riyal. This is including all our equity bridge loans, the guarantees provided for the equity bridge loans, for the equity standby LCs, and other funding guarantees. So you will end up with around 13 billion Saudi riyal of parent leverage. And then if you discount the cash that we have just presented, which is around 4.2 billion riyal, you will end up in a position of total parent level net leverage of around 8.8 billion Saudi riyal. So calculating the parent net debt over POCF, you will get to a number of 2.12 for the year 2022. Obviously, this is a number that is very healthy. However, we have a guideline over the years that is expected between, let's say, 5 to 6% multiple. So this is not let's say a reflection of where we want to end up. I think with the upcoming growth momentum, with the pipeline that we have, we will be comfortably sitting at around 5 to 6x over the next few years. This is all from my side, and we'll now take you through the Q&A. Thank you very much for your time.
Thank you. If you would like to ask a question, please press the raise hand icon on your screen if you have joined via Zoom, or if you have joined on the phone, please press star followed by 1 on your telephone keypad now. Alternatively, Zoom users can submit a written question via the Q&A function on Zoom. Our first question comes from Anna Antonova from JP Morgan. Anna, your line is now open. Please go ahead.
Yes, good afternoon, gentlemen. Thank you very much for the presentation and the very comprehensive comments that you have provided. Anna Antonova here from JP Morgan. I have 3 questions from our side. I would like to ask them just one by one, if I may. So first, rather technical question, but still, your parent operating cash flows were supported by 2.4 billion Saudi riyals of capital gains last year. Can you please comment what can we reasonably expect to see this year? To put it other way, is there a way you think you can further optimize your portfolio, or the asset perimeter looks satisfactory post all the recent deals that you made? So that's my first question.
Hi, Anna, and good to hear from you. So we'd like to ask the 3 questions today. Go ahead and answer.
No, answer the first one.
So definitely we have marked this as a one-off capital recycling. However, we are always opening our eyes for opportunities for divestment, capital recycling, refinancing opportunities that would be offered to us. We are actually looking at various options and opportunities during the year of 2023. I definitely see what we have achieved in 2022 is remarkable, and it is not a reference for us going forward. However, we will be growing. If you take the capital recycling out, I believe we are confident that we can grow from the level of 2022 as we are continuously going up. So definitely part of our model is optimization, and we will continue to optimize. We will never say no to any optimization opportunity. There is a tremendous opportunities that we are looking at. So we'll see where we'll end up at the year end.
That's all clear. Thank you so much. My second question is maybe a bit more technical in nature, but still, if I could pick your brain on the parent leverage. So I noticed in your MD&A report that you have restated the parent leverage lower by roughly 2 billion Saudi riyals, which looks like that you now do not include off-balance sheet guarantees of Acwa to the subsidiaries and associates. May I ask, why have you changed your previously more prudent approach to leverage calculation to the one that you're presenting now?
No, thank you, Anna. We did not change anything in terms of our structure. So to re-emphasize what we are doing, if you look at our balance sheet, so we presented around 24 billion Saudi riyal of total balance sheet exposure, right? So any exposure that is related to project finance, non-recourse, it gets consolidated to our assets just for the simple reason because we have or we own more than 50% of the company. This is not a recourse debt to us. So it was never in our calculation in the last decade that it has been part of our leverage ratio. So it is always out. However, we are also fairly adding back any recourse debt, even if it's not off balance sheet. So, for example, any liquid, let's say any standby LC related to, let's say, a financial obligation on Acwa Power, whether it is an equity bridge loan or is it a standby LC, or even for a funding, we add it back. And this is where we have added back 6.5 billion Saudi riyal. With that, we are calculating the leverage ratio. It was always the same. We never changed it since the last decade as far as RECO.
Understood. Thank you. And my final question is on the NEOM project, which is very big and very exciting. As you correctly mentioned, it's your single largest investment project. However, it's not the typical project for Acwa Power. So my question is, can you please shed some light on the expected project economics and the base case returns, and perhaps elaborate more on how you plan to increase those over and above those that you currently budget? That would be very helpful. Thank you.
Yeah. Okay. Look, first of all, just point of record, it is not our biggest. Jazan is bigger, but okay, that's neither here nor there. But it is very large compared to many of the others that we've got. However, as energy transition takes hold, I'm very confident that energy projects will all move towards these kind of sizes. Otherwise, we're never going to spend the $3 trillion that we're going to have to spend as a world to transition. But anyway, that's philosophical. Coming back to your specific question, look, I'm not going to get into specific sort of numbers on any project by project. That's not what we have done, and I don't think that's what we should be starting to do. But what I should do is immediately point out to you that this is not any different, so that we're very clear about it, to what we are doing with all the other projects. So it is being funded with a significant amount, 75%, of limited recourse project finance. We have an offtake. So we have a creditworthy long-term offtake. So it's exactly like structured, it is executed. We are executing, we are implementing very large complex projects and getting them built on time and then going forward and operating them. So it's the only difference. A big part of this project is the power generation side, and then there is a conversion of that power generation to molecules. And then we are shipping molecules as opposed to electrons. That's the only difference. And we have got a very strong, capable partner who has a track record, not in power generation, that's what we bring, but in molecule management, molecule generation and molecule management, who also is the offtake Air Products. So it's very much business as usual for us, except it is exciting, the first of its kind in the world, and this sort of sets the world on the path towards a solution for about 20% of the energy needs of the world by 2050.
Thank you. And going back to your slide 6 of the presentation, so maybe if you could comment more on the last bullet about the opportunities for higher base case returns. So higher ammonia
Sure.
output, for example, do you expect there could be some capacity added in terms of production after it is constructed or at some earlier stages?
Yeah.
Just could you shed some light on this?
Yes. So let me first, okay. So, we're trying our level best to not overcount the eggs. So that comment relates to the fact that we are actually building a plant that has the capacity to deliver more than 1.15 million tons per year of liquid ammonia. So that's a fact. That's what we are building. And we will, so therefore, but our contracted capacity is 1.15. So we've built ourselves quite a bit of safety margins and operating gaps, which we're very confident that we will be able to utilize. And I think I don't know, we will all have a different view perhaps, but my view, by 2026, the world will take any molecule that we deliver, any last molecule that is available to deliver. So we're looking forward to being able to operate the plant efficiently and generate more molecules than we have contracted, which in turn will then go to the market and generate. So that's one opportunity we have ahead of us. And the second opportunity we have ahead of us is, again, we have not counted it into the base case, but it is there. We have a very long lease on the land, well beyond the PPA. The offtake agreement. And the fact of the matter is, the plant is not going to vanish or evaporate once we finish the contract. So there will be opportunity for us to continue to keep operating the plant, albeit with certain modernization, certain refurbishment at that time. But we have not sort of factored that in at this point. That's a bonus for the future. But more immediate, our expectation is that as we start operating this plant, we should be able to continuously improve performance, our own performance in operation and maintenance of the plant, the efficiency gains that we will be able to achieve. Definitely not in the first few years as we bed the plant, but certainly after a few years, particularly as we expect by then to have other plants of this exactly the same configuration. We've already publicly announced, for example, that we are developing the same block in Oman, and we're looking at the same block in other places. So we should be able to then leverage on that multi-site operations as we get into the details of operation. So all of these will be nice add-ons, but we have not convinced ourselves on this investment on the basis of all these nice add-ons. It's just that we're very mindful of it. We want to put pressure on ourselves by telling all of you so that you can come back and pressurize us to say, hey, what are you doing in 2028 or 2029? But seriously, these are real value propositions that we want to be out there and putting it on the table.
Thank you, Paddy. Anna, I would like also to add one specific point related to, I think, the second question you asked. While the definition was kept the same, during the 2021, also we had specific, I would say, performance obligation that is related to Namak and also other subsidiaries, which is by nature is non-financing obligations. That was already included in the formula, which was actually eliminated. And this is something very reasonably in line with what the definition is, because for us, anything that is non-financial should not be part of the leverage ratio. And also, we have been looking at these obligations for the last 10 years, and the likelihood of any of them happening is almost nil, based on which actually it was excluded from the calculation. However, the definition by itself was always looking at it from a financial point of view. So this is what we have done. You are absolutely right. If this is also answer your question.
Yeah, that's very helpful. Thank you. And just to be perfectly clear, so if I heard you correctly, so you said you're building the plant for, going back to NEOM project, that you're building the plant for 1.5 million tons of liquid ammonia capacity.
No.
With contracted 1.15, which means 0.3 million tons is the merchant exposure, or is that, correct?
No. Sorry. No, I'm not quite sure where. Somewhere along the way we lost it. 1.5. No, there is no 1.5. We have the contracted capacity is 1.15 million tons per annum. We are building a plant that will deliver more than 1.15. Okay, we're not at this point declaring how much more, but definitely there is more that is worth considering. We have not factored that into our investment case or the base case, but we recognize that we can achieve more, and for sure we will achieve more, and we will then approach the market at that time with that additional capacity as it comes online, as to how we contract that, whether we take it through into a spot market, depending on how the market has evolved by then. My personal view, this is my personal view, but even by then, I think the world will still be procuring hydrogen on a capacity basis or on a long-term offtake basis. So once we become confident and comfortable, particularly during the first year of operations or the first 18 months of operation, we should then be able to get into discussions about how to contract that additional extra capacity that we have. So that's very much a bonus. It's cherry on the cake.
All clear. Thank you so much. No more questions from our side.
Thank you.
And our next question comes from telephone lines and comes from the line of Oliver Connor from Citigroup. Oliver, your line is now open. Please go ahead.
Hi all, thank you for the presentation and congratulations on the strong set of results despite obviously operational challenges that you described in the year. Two questions if I can. First one on that sort of operational side of the business. I know Oscar, you mentioned around trying to improve the availability up to sort of 90% plus and get back to your targeted levels higher than that. But how should we think about this year in terms of sort of overall revenue growth and JV income? Because clearly you've got plants ramping up from the end of last year, but do you see that sort of reversal in availability coming through this year to give you that boost, or are we still going to be slightly negative on that from where we are this year? And then the second question, just on NEOM, I know you can't speak specifically in terms of returns number, but how do you think about the returns of that asset now versus in 2020? Because I understand it from Air Products is that the ammonia price hasn't changed, but clearly the investment has changed significantly since 2020 and the financing costs. So how has the returns on that project shifted in your mind since inception? And then if I can just follow up on that, I mean, obviously the announcement on the Sharik investment coming through from the Saudi government, that's clearly going to have a role here. And so just wondering how that dynamic feeds into your returns analysis. Thank you.
Yeah, okay. So let me sort of start off, and maybe you want to add, if you want to add anything. On the first question, look, let me be very straight about it. We are operating, the renewables actually, by and large, are some of the more straightforward stuff. But we still have a gas fleet, and we've got a couple of residual oil-fired power plants. These are plants that operate at crazy speeds, operate at amazing sort of pressures, put together by a bunch of people. I'm always fascinated as to why we think they should work, but they do, fortunately for us. But then they do fail. Okay, so I'm going to sit here and say it's going to be perfect. We've overcome all our challenges. What I can tell you is that the sort of significant challenges that we have been plagued with over the last few years, as we have brought more of those kind of plants online, we are working through them, and the very targeted exercise that we have been undertaking, we see already the benefit of that with the outage pattern, unplanned outages. So I'm confident that bar any surprises, and I'm not going to sit here and predict any surprises. On the operating fleet, our performance, and this is going to be my worst nightmare now, but I'm going to say it. But really, I'm expecting our operating fleet to be performing better than it did in 2022. As I say, definitely North 3 contributed significantly to the deficit in 2022. It's back online. Marjan, we are sorting out the issues. Okay, I dare say with the number of assets we have got, some of the surprise will pop up, but at the same time, I think we are getting better at surprise management. So I'm confident. Is there anything you want to add to that?
Yeah, I would like to add one point. Thank you, Badi. Is number to number, the comparison also include some recoveries. So we have already done some recoveries from the insurance companies, some recoveries from the APC contractor. So while the outages that have been described by Badi is significant, but with that recovery, you have seen the difference is only 87 million from last year. So operating wise, it could be better. Financially, we have recovered some part of the loss, and this is actually part of our business model where we are fully protected, to some extent,
or substantially protected,
from with the insurance coverage, with some liquidated LCs and standby LCs from the APC contractor related to delays or during the warranty period, any outages. So that is also an important point to factor.
Thank you. Yeah. So good point. So that's that. Moving on to the second question on NEOM. Look, so the way you presented it, let me just stick to that for a minute. So capital cost has gone up from the time we started developing the project. The selling price of ammonia as declared by Air Products has remained the same. Okay, simple mathematics. Of course, we're not going to make as much profit as we thought we would. But the bottom line is, when we started developing the project, we had budget estimates, and we might have extra celebrated the wonderful returns. And as we then absorbed all the challenges, and by the way, that the increase in cost is not entirely on a overall. Yes, there's been an increase in cost, but there has been performance increments as well embedded within it. And as I said to you, we are ending up building a plant that is sized to deliver more than the contracted volume. Just for rigor, we have done the financial close, the entire limited recourse financing, our base case, on the basis of that contracted capacity. And we've kind of kept that as a cherry on the cake. But the capital cost is embedded. So overall, I'm not going to get into the details. Not going to get into the details of any project on a project-by-project basis, but at the same time, we are comfortable with the investment case. My board investment committee was comfortable, and we have invested on that basis. In the case of Sharik's contribution, first and foremost, everybody is sort of jumping into the Sharik contribution as a kind of financial investment or a financial contribution. Actually, I want to point out that, okay, it's early days, I think, for all of you to understand what Sharik is. We have worked with Sharik on this with a part of the first wave of projects. And so we have seen it in action. Sharik is very much, as I see it now, at an operational level, a one-stop shop that helps us with regulatory support. Look, we are operating in many, many countries. What I can tell you is that in the Kingdom of Saudi Arabia, all the government agencies, particularly today, are extremely welcoming. They just want to solve problems and allow you to get on with the project. So we do get a good reception, but it's very good to have a powerful agency like Sharik standing alongside us as we then get into regulatory issues and to find solutions. So they bring a lot of value beyond the co-financing that they provide. But definitely, the co-financing they provide the value of it is not just necessarily in reducing overall financing cost, it's much more, it is in terms of giving more confidence to the limited recourse debt financing provider. So I have no doubt, I mean, okay, I'm not sitting there doing the RAROC calculations for the banks, but I have no doubt that the pricing that the banks have given us will be different with Sharik than without Sharik, for example. It's always good to have, I mean, we know that from all the project financing that we do, to have sovereign lenders, multilateral financing agencies, they definitely bring the overall cost down, regardless of what their cost of capital or what they are offering into the project. So all in all, this is all part of that package that has allowed us to become comfortable. Well, first of all, allow the limited recourse project financier to participate in the project. 75% of the money is coming from them. And then for us, 25% equity providers to invest in that project. And I am definitely not answering your question on dissecting into the numbers, sorry. So please don't, forgive me for not delving into the detail.
No, thank you. That's very helpful. Thank you for that.
And there are currently no further questions registered, but as a reminder, if you would like to ask a question and have joined us on Zoom, please use the raise hand icon found on your bottom toolbar. Alternatively, submit a written question using the Q&A function. And if you have joined us on the phone, please press star followed by 1 on your telephone keypad now. Our next question comes from Govindir Kumar from HSBC. Govindir, your line is now open. Please go ahead.
Yeah, hi, thanks for the presentation. My question is about your estimate or your guidance on capital expenditure in 2023, and also if you could give some guidance on investments in equity associates in 2023.
Yeah,
Good question, David.
yeah, thank you very much. So I think what we have demonstrated in upcoming pipeline is actually a rich and busy pipeline. Actually, this is 2023 is a busy year that started from the early time. So not only with NEOM, but we have a very, very strong upcoming pipeline of projects to be closed. So Paddy already highlighted our investment in NEOM, our investment also in the upcoming 4+ gigawatt in the PIF framework. We are also bidding into a couple of projects. So I can highlight a few. So today, for example, in Dubai, we are bidding for the upcoming water desal in Hassian, IWP, and also we are bidding for phase 6 I would say, in Dubai. One PV project in Abu Dhabi also is in the pipeline. A few other wind projects also in Uzbekistan. Yeah. There is a target to close also one new project in a new territory, Azerbaijan. It has been in the pipeline for a while, but we are targeting also this year to achieve something there. New countries, we are looking at it also from a green hydrogen perspective. So these will take a bit longer time compared to the PV and wind project that we are looking at. There is 4 CCGT project in Saudi, Qassim and Taiba, that also we are bidding for them. Overall, we are expecting to invest higher than what we have invested in the past or in the 2022. In fact, our target is to invest more, depending on, of course, our winning ratio, depending on how successfully we close a couple of these projects of PIF framework agreement into a financial close. And we are, with that, we are expecting to be higher. Of course, we don't usually give a guideline of a number, specific number that we want to achieve by 2023, but inshallah, our objective and target is to go more.
Okay, thank you. Thanks for this. One more question, if I may. This is about the amount of electricity that you generate. Pardon me if I have not missed it somewhere, but do you report that, or could you just provide that information? Amount of electricity generated. I know you disclose availability.
Yes, 44. So it is 44.4 gigawatts.
Our contracted capacity is 44 today as stands. 44 gigawatts of contracted capacity.
And this is where Paddy has mentioned during 2022, we have increased it with this 12%, which is the 5.4 gigawatt. So with the 5.4 gigawatt, we have reached 4.4, which is a 12% growth on the power capacity
contracted capacity.
All right. Thank you.
Just to put that into perspective, this is a capacity equivalent to UAE capacity, I would say. But UAE is around 43 gigawatts.
Yeah, the country of UAE.
Contract, yeah.
If you were Africa, would be the third largest.
And sorry. So is it a good assumption that you produce all that you contract?
Yes.
Okay.
Yeah,
because we are all on PPA, capacity contracts.
Yes. So of course, some of these are actually during, I would say, a phase between award until financial close. Some of them from financial close until construction, COD, commercial operation date, and some of them already operate.
No, if you're asking specifically the electricity that we are dispatching, in a few weeks' time, we will announce the numbers in our annual report. So if that was your question.
Yeah, if your question was terawatt hours or megawatt hours, that'll come through.
Yes, exactly.
Oh, my apologies. That'll come through in the annual report.
It will come in the annual report as part of sustainability insert.
All right. Thank you.
Thank you.
And just one final reminder today, if you would like to ask a question and have joined on Zoom, please use the raise hand feature or submit a written question in the Q&A function. If you have joined us on the phone, please press star followed by 1 now. And there are no further questions, so I'll hand back to the management team for any closing remarks.
Well, thank you very much for your time. I'm glad you have been able to share that time with us. Look, I'm sure Oscar is now going to tell you that he's available day and night. I'll leave him to do that. But in the meantime, I will thank you for the opportunity for us to be able to share our 2022 with you and our brief look into what is exciting and what we look forward to into 2023. Thank you very much on my part, Oscar.
Thank you, Paddy, and thank you, Abdulhamid, and thank you, everyone, most importantly, for joining us today. As usual, if you have any questions, you know how you will reach us, and I don't need to repeat that even any time of the week or the time of the day. Anyway, thank you so much, and have a wonderful day or evening wherever you are. Thank you.
Thank you.